Good afternoon, everyone. My name is Emily Drake. I'm a managing director here in Fairport's Cleveland office, and we have the privilege of welcoming clients across all of our offices, including Buffalo Grove outside of Chicago, Harrisburg, Pennsylvania, Buffalo, New York, Princeton, New Jersey, and our most recent addition, Cherry Hill, New Jersey. As always, it's our pleasure to serve and inspire you and your families. Based on past feedback, these webinars are scheduled on a quarterly basis, and you'll see leaders from all of our offices take turns moderating. The goal is to connect you directly with John Silvis, our Chief Investment Officer. John will recap where we've been, his thoughts on where we are today, and some thoughts on what the year ahead might bring. We did ask for questions in advance. John and his team have prepared slides addressing those and other frequently asked questions. Be assured your advisors are in continuous contact with the investment team, and here's some ways that you can be too. You should be receiving Fairport perspectives via email. If you're interested in weekly updates, ask your advisors to share our weekly Fairport market note. You can subscribe to Fairport Flash, a monthly podcast available on Apple Podcasts and Spotify. And finally, you can follow the hashtag Investing with Fairport on LinkedIn and Facebook for frequent thoughts on the markets and economy. As always, you are muted on this webinar, and of course, we can't see your faces. But if you have questions during the webinar, you can type them in the chat window, and we'll answer as many of those as we can, time allowed. With that, it's a pleasure to turn over this to one of my favorite people and our Chief Investment Officer, John Silvis.
Thank you, Emily. I don't know if it's too late to say this, but Happy New Year. I guess we're getting closer to the end of January than the beginning, but feels like we just turned the corner. So it's been, 2023 is an interesting year. I don't know if they still do the word of the year or not. I know they used to do that word of the year. I know it's one of the magazines at Time or something like that, but I would probably think artificial intelligence or AI would be one of the words that would be considered. As you can see kind of in this joke, no one seems to want to do their homework anymore. Everybody's going on to chat GPT or whatever, but it's something we've talked about a lot. I know we've gotten questions from clients, but I was at a conference last year in April, so almost a year ago, and it's really my first exposure to it. It was a Blackstone conference, and they did an example on the board of what they were using Chat GPT, and they asked it to write a job description. And I was kind of floored. I was amazed by how good it was. That it came right up. So we kind of think this is a theme that has a lot of legs, and we're going to see that going throughout the next couple of years. It's something we talked about in our themes, which we'll get to in a minute. But I definitely think we'll be hearing about it more in the future. So. As far as 23 goes, or 2023, equities rebounded, really started back in late 2022 in October. I kind of think we're in a new bull market from that stage. As you can see, if you look at that column to the far right, large caps were the best performing asset class last year, 26%. Both bonds and stocks did well. Bonds kind of had a late rally into the year end, and I actually have a chart to talk about that. But as you can see there towards the bottom, fixed income or the bond, and that's represented by they call it the Bloomberg Ag now, which was about 5.5%. So late rally for the bonds, but equities had a pretty good year, very consistent. Had a one pullback of about 10% during the year, but volatility was actually very low. As I always comment on these things, we like to take a longer term view. So if you really go back and look at the last 5 years, and it's been a pretty good example of just volatility in the market. We've seen a pandemic, we've seen a recovery, we've seen rates go down, we've seen rates go up over the last 5 years. But through all that, the ACWI, or the All Country World Index, which is something we use as a benchmark for our equities, was up about 11.7% per year over the last 5 years. The S&P 500, which is a predominantly large cap U.S. equity index, was up about 15.7% year over year. Bonds had a difficult time, only up about 1% year over year. Most of that was front loaded in that time frame. And then small caps, which are an area we think will do well in the new year in 24, we're up about 9.9%. So if you take a longer look over the last 5 years, although it's been volatile and we've experienced things we probably thought we never experienced, the markets still have held up pretty well. So, again, if you go back to a few years ago, we had that discussion of this 60-40 dead last year, 60% meaning equities, 40% bonds, which is what we would define as a balanced portfolio. And that's something people have used for long-term asset allocation over the years. And, I think that's been greatly exaggerated. As you can see over to the right-hand side, the year 22, we obviously had a bad year. It was down 16% on a combined basis. So if you took the two benchmarks, 60 and 40, and you combine them, it was down about 16%. But in 23, we had a bounce back. It was up 18% for the year overall. Most of that was driven by equities, but some was driven by bonds as well. If you look at the last 5 years, an example, and I just mentioned that earlier, the overall average, you had one down year during that time period, which would have been 22, and then overall the average of returns about 11%. So again, in the big picture, I think I would say the demise is a little early on that one, and it's probably going to be greatly exaggerated. As far as themes for 23, if there's a second word that's out there that people would talk a lot about, would be the Magnificent Seven. I'm not sure who coined that one, but someone should put a copyright on it. But as you can see on the left-hand side, a large portion of returns last year, at least in the S&P 500, the large cap index, was driven by the top seven, or not the top seven, but these 7 names. As you can see them in aggregate, they're up about 20. They represent about 28%. If you look at where they started the year, it was closer to 22. So definitely dominated the market. There's a lot of talk about the other 493 names, but I think that was a little exaggerated. There's names like that we hold, like Costco and Parker Hannifin and MasterCard. I can name a few other ones, O'Reilly Auto. That all did pretty well last year, and they had nothing to do with AI or anything like that. But again, if you look at that chart on the right-hand side, 80% of the returns from the S&P came from those names, and they have them listed. There was Apple, Amazon, Google, Meta, which is the former Facebook, Microsoft, Nvidia, and Tesla. And as far as our portfolios go, I mean, in our ETF portfolios, we were overweight technology for most of the year, which is where most of those names reside. And out of those 5 in our individual portfolios, we own 5 of the 7 names. I always get the question, why don't you own 7? And the big picture is you can't own everything. We looked at a few of them. Nvidia was the real big one of that group. But again, I think as we go into the new year and we start into 24, I think you're going to see a broadening out of the markets, and we'll talk a little bit about that as well. I guess, if there were some positives last year, I think inflation peaked. The trend for inflation was definitely lower for most of the year. As you got past that April period last year, as you can see in the chart there, we saw it continue to come down. I think as we started last year, we talked about when will inflation peak and when will the Fed finish raising rates. I think as we go into 24, the comments are going to be, how low will inflation get, and when will the Fed start cutting rates? So kind of the other side of the coin of what we were talking about last year. As you can see, the darker blue line there, that's all items. So that's what they call the CPI, which is a consumer price index. We'll talk a little bit about the components in a second, but it's about it was at 3.4%, the most recent reading. And then the less food and energy was 3.9. We believe, and again, one of the themes we talked about is we think that's going to get down below 3% this year, at least on the one that says all items with a darker line, which would include gasoline and food, those things. And I wouldn't be surprised if we get down below 2.5% or somewhere around that area. If I had to take a bet one way or the other, I would lean to being below that number, not above it, but definitely below 3%. I think we'll continue to see that trend going forward. And really, at the end of the day, that's what's going to lead the Fed to make decisions on when to cut rates going forward. And so far, it's moving in their direction. The one thing that maybe was a negative last year, or something that we tend to watch very closely, is that it's a proprietary survey from Evercore ISI. And they do a company survey. I've talked about this many times over the years, but for those people that are new, they go out and survey CFOs of major corporations, and I think there's over 300 in the survey, and they ask them just to rank where they see business between 0 and 100, and anything over 50 is considered pretty good. And for the most part, we started the year off above 50, and we saw a big rally off the lows in 2020 because of the pandemic. But we're starting to see that drift, and historically speaking, you can see it with the gray bars here. As you get down to that 45 range, it tends to be a signal that we're heading towards recession. So we're just under 50 at 49.5. It's something we're keeping a close eye on. Our base case is we don't think we'll see a recession in 24. If we do see a breach of that one line, that'd be one indicator that maybe would have to rethink our thoughts. But it does fluctuate. So we're not throwing the towel in yet, but it's something we're keeping a pretty close eye on. And the positive of 23 is we had a pretty strong finish. We had a consolidation, like I said, about a 10% consolidation. Then we saw markets rebound near the end of the year. And historically speaking, when you get a 10% gain in November, December combined, as you can see here, I think there's six points there. Historically speaking, as you go into next year, it tends to be a pretty good indicator of additional gains or momentum picking up and heading into next year. And we had a lot of things, what I would call breath thrust indicators, and I won't bore you with all the details, but they're things that we watch pretty closely, and they were all kind of triggering late in the year. So on average, as you can see in that red box to the right, you get about a 19%, maybe 20% return. But historically speaking, the more important point is it tends to have higher markets a year later, 100% of the time since this has happened, going back to, I believe it was 1950. You see that happen, and we think that's a good indicator for where markets will head going into 24. I'll kind of pause there for a second. I don't know if we have any questions pop up, or if you have any questions.
Yeah, John, we've got a couple, and some you may have addressed already, but let me just repeat it. One is, do you expect the dominance of the Magnificent Seven to continue into this year?
Okay. So I have a chart here in the packet. I haven't got to it yet, but I think we're starting to see a broadening out of the markets, which is good. Like I mentioned, as we got into November, December last year, it's hard for the markets to really have a broad rally if only 7 stocks are leading. So you saw 90% of the stocks in the S&P 500 were above their 50-day moving average. So that's not something that's just led by 7. 90% of, you can do the math, but 90% of 500 names is way more than 7 names. So I do think there's a broadening out. I think that's, if we're going to have a sustained bull market going forward, I think we're going to have to see that. That probably means you're going to see better participation with small mid caps going forward, which is another thought or theme that we have this year, and we think we'll see that. We did see that come off the last few months of the year. We had a little bit of consolidation. We're only a half a month into the year, so it's not. I wouldn't get too concerned. Sometimes, like a lot of markets, you have to kind of burn off some of the overbought sentiment. So I think that's just natural. So yeah, I do think that we'll see a broadening of the markets. I'm not saying that the Microsofts of the world or the Apples will lag, but I don't know if they'll be such a dominant market leader going forward.
The other question you're likely to address going forward, but I think it's important to point it out. We have a lot of clients that have been enjoying very high money market returns.
Mhm.
and cash. And, cash is always nice, especially when things get volatile. So do we expect those to maintain, or do you see that falling off with rate cuts this year?
So I think the short end of the curve, which is really what the Fed has the most um, control over, which is the Fed funds rate, which is closely tied to money markets. I think that will come down at some point this year. Now, I got a couple slides on our thoughts on when and if, but I think the answer is they will cut rates this year. The timing is kind of up in the air, so that's remains to be seen. But as that happens, uh, the attractiveness of the money market rates will come down. How rapidly, again, depends on how fast the Fed moves. So um, there's a term called cash sorting, which is a new term. I'm throwing a lot of words of the year out, but maybe that's one of them as well. But and it basically means people are taking money out of bank accounts, and I think most of our clients know, our friends know that the returns you're going to get on a savings account or money market at the bank is much less than you would get at a Vanguard or a Schwab or a Fidelity. So there are people looking for chasing returns on the cash side, and that's happened a lot. So people are definitely looking at that, and they're moving money around to get the best yields, which I don't blame them for doing. Um, but I think as we get into the middle part of this year and we do start to see rates come down, um, uh, that attractiveness will wane a little bit. I don't know if people will. I don't know if we'll get down below 3% or 2%, but I think you'll see lower rates. So, and there's always that fear of missing out kicks in somewhere, and there's a lot of money in the sidelines, and we'll talk about that in a minute. But so, uh, yeah, I think it's hard to pass up 5%
Yeah.
risk free, but I think as you see returns, much like last year in the market, and if we see positive returns this year, um, and rates going down, I think you'll see that money start to return back into the markets.
Thanks. That's it for now.
Okay, great. So the economy, I think the economy has been pretty resilient in 23. Most people were calling for a recession at some point early in the year or mid-year of 2023. Never really materialized. In fact, if anything, the economy seemed to pick up in the second half of the year, and I'll show you a slide on that soon. But a couple of things that we're looking at, and these aren't all the ones we talked about, but some of the highlights. We do think the economy will probably slow some in 24, but we don't think we're going to see that recession or hard landing that people are talking about. We think we will be able to avoid that. I think the Fed's already started to shift their focus on the economy and on unemployment, but we do think that they will start to cut rates multiple times in 24. As we just talked, Emily and I don't know exactly when that's going to happen. I can tell you some numbers. The Fed Watch, which is the futures market, had a rate 82% chance of cutting rates in March, and that's kind of come down now to it's about a 50-50 coin toss. So we'll keep an eye on that, but they will definitely cut rates, I think, this year. And then interest rates, I think on the longer end, more like on the 10-year Treasury, it's our belief on the investment team that we'll see some fluctuations there, but the high point last year of a little over 5%, it might have been closer to 5.25, is probably going to hold. We're somewhere around 4.10, I think, today on the 10-year. We can get to 4.5, or even maybe push closer to 5, but I don't think we'll see new highs this year. And then, as I already mentioned, we think inflation will settle somewhere below 3%, probably closer to that midpoint between 2 and 3%. So, but I guess, as I mentioned a couple minutes ago, the economy held up pretty well. Third quarter GDP was 4.9% on an annualized basis, quarter over quarter. Year over year through the third quarter, we were up 2.9%, which is above trend, which is about 2%. Fourth quarter is not done yet, or well, it's done, but it's not been reported yet. But I've showed this chart before. We follow something called the GDP Now, which is a reading or a econometric model out of the Atlanta Federal Reserve Bank, and right now it's predicting about a 2.4% growth in the fourth quarter. So again, they've been pretty accurate. So I'm going to guess it's going to be somewhere above 2%. So again, we finished the year on a positive momentum. We'll see how it carries forward into this year. So far, not been a lot of data points that would indicate that that's going to change anytime soon. So, but I think we've been pleasantly surprised last year on the resiliency of the economy, and I think that'll continue as we go forward. One of the reasons we think that's going to happen is because inflation is coming down. We already showed the chart where we were at peak back earlier last year. One of the drivers, and this is a survey through Evercore, they survey, as you can see down below, they survey large companies that own about 75 or 750,000 apartments out there. So it's a pretty broad survey, and rents are coming down. And one of the biggest inputs on the CPI or Consumer Price Index is owner's equivalent rent. So that's a good sign. This survey tends to be a leading indicator, so we'll see more of those showing up in the inflation readings as we go forward. So another reason why we think that inflation is more likely to go down, not up. And the other one is used car prices. To go back to the pandemic time, you couldn't get the chips to go into cars. There was no new cars on the lots, and people were buying used cars, and used car prices went up because of that. Well, I think most of those supply chain issues with the new car companies, or the new cars from the Fords and the GMs of the world, have been fixed. So you're starting to see more new cars on the lots, and used prices are starting to come back down. So that's another big indicator within the inflation index. So I think again, it's going to be a positive leading into inflation in 2024. I'm not used to saying 24 yet, so to me it's a little tough. But a couple other ones, and I just kind of grabbed these headlines from one of our research groups. But Apple's cutting or giving discounts in China for the iPhone 15. They rarely ever discount the product. Kia's cutting prices. This doesn't really affect me. I don't buy a lot of diamonds, but diamond prices have been slashed. I know Emily buys a lot of diamonds, so probably.
Yeah.
I don't know much about the lab grown diamonds, but I guess that's pushing prices down. So market forces will always prevail. And then Tesla slashing prices in Europe and China. So it's just not a U.S. thing. It's definitely a global process where you're seeing prices either stabilize or actually start to come down a bit. So I think that's a big positive going forward. So before we jump into the markets again, I'll see if there's any other questions out there.
Yeah, I guess I'm just going with every client meeting I have. One of the big questions is how is the election going to impact the market?
All right, we got a slide later on about the election. I was hoping we'd get through this whole thing and never talk about it. But
Impossible.
I will talk about that. So hold that question for later, and I will.
Okay.
All right. So let's talk about the markets. This is again our thoughts, myself and the investment team, on where we see the most likely path going forward. We think we're in a current bull market that started back probably in late 22. Expanded throughout 23, and now we're entering 24. Emily and I were talking about right before we started about where the S&P was, so we're really close to new highs already. I think it's important we punch through there at some point. I don't know if it'll happen this month or not. I think we mentioned this earlier as well. I think artificial intelligence is kind of still in the early stages. I think there's an analyst out there that's on all the shows, and I think he's one of the better analysts. And he has given presentations. Actually saw him at a high tower event earlier, late last year. And, it's just beginning to really start to creep into earnings and margins for companies is how they use this and how they can increase productivity. I know a lot of people compare it to the internet revolution. I don't know if it's going to be that big or not, but I do think we'll see people continue to use it and continue to make products and processes more efficient, and that'll lead to the bottom line. So something we've been keeping a close eye on. to Emily's point, we'll probably see more volatility this year. We had a very low volatility year last year, so they tend to ebb and flow. So it's more likely we'll see that. We tend to see them more in election years anyway. We do have an election, as she pointed out. We have a pretty evenly divided electorate. If you've been watching closely, trying to get the budget passed over the last 3 or 4 months, it seems like it's incremental steps along the way, and it's very hard to find for these both the Republicans and Democrats to find common ground. So I think that's going to continue. We have a couple different hotspots around the world that are, we're seeing global unrest. Most recent would be in Israel and Gaza, on top of what's going on in Ukraine. I read the paper this morning, and we continue to have airstrikes in Yemen. So who knows? We do think that small caps will extend their late bounce last year, and we think they'll outperform large caps this year. We do think stocks and bonds will outperform cash. To the point made earlier, I think short-term yields will fall from their highs. How far, I'm not really sure, but I think that risk-free rate of 5% is going to come down. And then I think the emerging markets outside of China's struggling with a lot of issues, will outpace the developed markets this year, as we see inflation globally come down and a resurgence of growth going forward. So, valuations are stretched. There's no doubt about that. We keep a pretty close eye on valuations on a forward going basis. So the price to earnings over the next 12 earnings over the next 12 months, and we're pushing the close to 20%. We're at 19.5 at the end of the year. That probably moved a little bit over the last few weeks, but we're probably still in that range. I think as rates fall, that tends to be a pretty good backdrop for multiples. I don't expect to see much expansion in multiples at this point. Again, we're in the high end of the range. I do think earnings are going to grow somewhere between 9 and 10% this year. Could see that again in 2025. So I think a lot of the returns going forward will be more earnings driven than multiple driven. But we are well aware that we are on the higher end of the range. We actually have, on occasion over the last couple weeks, taken some profits in some names we really like, but just seem really richly valued. So this kind of goes back to the comments about the short term and the long term interest rates. As you look at this, it's a little busy, but you have the yield curve here, and we expect the short term rates to fall. So if you look at on the top there, you have a green line and a blue line. The green is where we were at the end of 22. The blue line is where we're at the end of 23. So 3 weeks ago. And as you move from the left side, that 5.3, that's basically where money market rates are. That's the short end of the curve, and they're still there. Where most of the rate decline will be from the Federal Reserve will be on that short end. So that 5, if they cut rates by 150 basis points, it's likely it's going to fall in line with that. So that's where you're going to see the biggest drop in rates, which leads us to believe that although even at 3.5% or 4% is still a pretty attractive yield, I think people will start to move out of money markets, and either further out on the curve or back into riskier assets like equities. We get a lot of conversations about cash and where we're at on markets and how can we lock in rates. A good example, my colleague Rick D'Amico, if you want to have a longer discussion on those things, reach out to your advisor. He'd be happy to have a conversation with any of the clients. But we've been a good example. We've been using even in municipal bond accounts, using some treasuries on the short end of the 1 to 2 year range, because it's a better yield relative to munis even after you take into tax consideration. So there's a couple opportunities out there that I think you can take advantage of with the inverted curve. If you ever want to talk about them, feel free to reach out, and we're happy to do that. So again, it all really comes down to the timing and when these things will happen. The Wall Street, as of a couple of days ago, was highly expecting cuts at the start in March. That's come off a little bit. There was a couple Fed speakers over the last day or two, and President Goolsbee from the Chicago Fed spoke today, and although he thinks rates will be cut, he thinks they'll be cut more in the second half of the year. So that those odds are coming down. But this is a forecast from Goldman Sachs, and it's pretty indicative of most of the firms on Wall Street. They see 3 consecutive cuts in March, May, and June, as you can see with that with the arrow in the middle of the page, or middle of the chart there, and they think eventually Fed fund rates over the next 2 years get down around 3.5%. So that would be about 200 basis points at 2%. And if you do it 25 increments, that's 8 cuts. So it's a lot of cuts. Historically speaking, forecasts that far out are never that accurate. So I wouldn't put too much into it, but I do think we'll see some as we go forward. But again, strong finish for bonds or stocks, and I mentioned how that tends to carry forward going into the next year. We also had a pretty strong finish for bonds, and as you can see on the left side, the yellow bars in November, December, as it became more apparent that the Fed was pausing, rates started to drop. And as rates started to drop off that 5% back down to below 4, you saw a rally in bonds, and you saw a pretty good return in those last 2 months. Historically speaking, it puts you in the top 10 of 2-month returns, and it's a pretty good company to be in. If you look at, it's not as strong as the equity comparison that we had earlier, but about 78 to 80% of the time, you'll have a positive return the following year. So again, better than average, and so it skews returns positive, which means rates will most likely have to come down again. And as you can see on the right side on the table there's been a few years where returns were negative back in 80 and 81, but overall, over the last I think 7 times it happened, we saw positive returns the following year. So that kind of goes back to our thought about why we think you'll see both stocks and bonds outperform cash this year. And just to kind of tease it all, to Emily's question, stocks, we are in what they call the presidential election year. There's a 4-year cycle that a lot of people follow, and the 4th year being the election year, which we are currently in. You tend to see a little bit of a sluggish start to the year. If you go back, this goes back almost 100 years, goes back to 1926. And first and second quarter, you have somewhat muted returns. Third quarter, again, kind of starts leading into the election season. Usually, in most elections, although the last few here have been very close, you tend to see a front runner break out come sometime around Labor Day into election. And then the third and fourth quarter, you tend to see better returns. I wouldn't be surprised if we kind of follow that same pattern this year. We had a really strong end of the year, so it wouldn't be surprising to me if we see some burning off of some of the overbought conditions over the first month or two, and then see some consolidation. I think it's more likely that it passes over time versus a drop in the market. So when you see consolidations, and then heading into the second half of the year should be fairly positive. I know we had the Iowa caucuses last week, I guess it was this week, and New Hampshire's coming up at some point. We live in Ohio, so we're like in the middle of the pack. I don't know, but so we'll get better clarity, I think, on who the front runners are, and probably going to be something similar to what we saw last time. So I'll kind of pause there. I'm going to get a drink of water, but any other questions?
Yeah, you talked about, first of all, you give the impression that it's going to be a good year, all in all, maybe with some more volatility. But you talked about the company surveys and PE ratios and things that you're watching. Anything else that, if things switched, you would be concerned with?
So our colleague Rick D'Amico, again, Rick's one of the valued members of the investment team, and he follows the rates much closer than I do, and he follows fixed income, does most of our bond investing for us. One of the things he always looks at, and we do as well, is credit spreads. So you're looking at usually when you start to see delinquencies pick up and the economy slow, credit spreads, meaning the difference between um, uh, I'll just use example a AAA bond versus a B bond, and what that means is like a high quality company versus a high risk company. And when the spread between those is very narrow, it tends to say that the economy is looking pretty good and things are doing well. As it starts to, and it will ebb and flow over time, but as it starts to widen and really start to get back to historical highs, then that's usually a good sign that the credit markets are under a little pressure, and that's probably a sign that the economy's on the verge of slowing. That hasn't happened either. So that'd be one of the main ones we're looking at. So that, right now they're kind of mixed, but I would say, 60 to 70% are still leaning towards no recession, but it's not a unanimous thing. So, and it rarely is. You have to kind of read the tea leaves a little bit, but that's another one we'd be looking at. Um, you know, I tend to watch the earnings come out. So far, earnings are looking pretty good. I'm actually looking at earnings more towards 25 already, 2025, and it's kind of hard to believe, but just to see where guidance is, because if companies continue to guide down earnings, that tends to be a sign that they believe things are slowing as well. So we haven't really seen that too much, but those are kind of just some of the other things that we look at.
Okay.
You kind of have to build a mosaic of it all and kind of weigh them, because they're not all going to all point in one direction. So
Thanks. Well, I guess that you're probably going to address this, but the question that often comes up in meetings I have with clients is regarding AI and how much we're participating in that explosion.
yeah, so yeah, that's a great question. And so I kind of mentioned some of the big players earlier. And in our large cap portfolio, we own, out of those magnificent seven, as they call them, we own 5 of the 7. We also own Broadcom, which is a big semiconductor name, which has benefited. We own a company named Arista Networks, which has done really well last year. It's not as big as some of the mega names, but it's a cloud computing name, which, again, if you're going to ramp up your artificial intelligence and stuff, you need to store all the data. So the cloud names tend to do well there too. So, I think, as I mentioned earlier, we think it's a theme that has legs. So, we have positions in those names. We don't really intend to trim any of those or remove any of those from our portfolio. So I think, we recognize that there could be some pullbacks along the way and some bumpiness that always happens. But overall, we're definitely overweight the communication services, the discretionary names. And in fact, I'm going to show this. I'm going to just do it right now. So I think we're well positioned to take advantage of that. We don't own all of them. It's kind of hard to own every one, but I think we own a pretty good representative of that group. And our view of the world is, we think there's further to go there. I think it's again, I don't want to call it the next internet, because that's a pretty strong statement, but I think it's a thing that will continue to go, especially as we start to see productivity gains through it. And then, even on some of our ETF only models, we've been overweight discretionary and information tech. So again, you're getting exposure to those names as well. And I don't think that'll change either. But so, for example, this is where we remain overweight and underweight in our large cap model relative to the benchmark. And we have been on the cyclical theme for a while. Industrials, consumer discretionary, and information technology are the 3 big ones. And then on the other side, we're underweight defensive names like utilities, healthcare, and staples. But I will tell you, healthcare is an area we've been keeping an eye on. I mentioned it in the on the title of the page there. It's one of those areas. It's kind of so bad it's good. It got beaten up last year. Always comes under headline risks, between politics and other things. But we like the area. I think the valuations are really good. I think there's going to be a broadening out, like we mentioned, in the market. So it won't just be a tech 1 Mag 7 market. and some of the areas which look really attractive are in healthcare. So it's an area we keep looking at. We started the year off about 3% underweight. Now we're only about 2. We have added some. Our colleague Mac Muirhead runs our large cap portfolio, and I think we'll see us a lot more scrutiny in that sector. And my guess is we'll be adding to it as we go forward. So
Great.
So domestic equities, and I just talked about where we're at on a sector basis, but overall domestic equities look like they're continuing to break out versus international stocks. We had a little bit of a pullback there at the end of mostly 22 to the beginning of 23, where you saw that, but we've seen a turnaround. I should put that red arrow there where you can see the turn, and we think that'll continue throughout the year. We think domestic equities, the U.S. tends to lead out of these things, and we're kind of leading out of what was the post-pandemic global environment. And I think as we continue to tame inflation, I think you'll see domestic equities continue to outperform. An area where I think we're more positive than we have been in the past is in the small caps. They definitely started to rally late last year. One of the peculiar things about small caps, and if you get into the nitty gritty of them, they own a lot of community banks. So it's the smaller banks, not the Citigroups or the PNCs, but more the I'll use one here in Cleveland area, Lakewood Savings or something like that, or your small town banks. And they all came under pressure earlier last year. There was concerns about banks. Some of the banks were in bankruptcy. There was the Silicon Valley and a couple other ones. So there was some concerns there. Put a lot of pressure on the small caps. I think we've kind of come out of that recently. So we've seen a rally, a little bit of a pullback recently, which I think is expected on a big move like that. But we think, again, as rates start to come down, the cost of capital starts to come down, and I think the dust settles in some of the banking issues. I think small caps are kind of set the rally here. So that's an area we've added to our small caps in some of our accounts. Probably continue to see us do that as we move forward. Still overweight domestic and emerging markets relative to developed markets. That hasn't changed. I've showed this before, but historically speaking, if you're overweight those two areas on a long-term basis, you tend to see better returns. I don't think that anything's changed there. Japan has had a pretty good year, so that's probably one area I think that might be seeing some continue to see a breakout, but relative to the rest of the world, we still like the U.S. and emerging markets in that. So to answer your question 20 minutes ago, you asked about the Mag 7 versus the other called 493, which again, I think is probably a little oversimplistic. But that being said, this is a chart that Strategas put together, and they actually came up with a Mag 7 index. So relative to an equal weighted S&P, as it's gone down, that was meaning that the Mag 7s were outperforming. We're starting to see this base forming here, which goes back to that October period that I said we kind of started to see things widening out relative to leadership. And I think it's continuing into January, only a couple of days into the year, so it's early to say it's a trend, but we think that'll continue. And I think there's room for both to go up, but I think the dominance that we saw last year probably won't be as evident this year. And I think that's good. If you want to see the bull market run and continue to expand, you're going to need other areas of the market to contribute. Any other questions?
John, I think that we've covered all the questions that I've had.
Okay. Well, there's a couple things, what we're watching. Some are earlier things. Some are things that'll be probably more in the second half of the year. Emily kind of tipped our hand a little bit. So I use this, I think this is Yogi Berra, right? It's deja vu all over again. So it's starting to look like it's going to be a Trump-Biden rematch. I don't want to say that for certain. There's plenty of states left to go, but like I said, there's a New Hampshire primary coming up very shortly here. I don't think President Biden really has any competition. President Trump seems to be jumping out. So I'm not making any predictions, but this is the earliest poll, one of the earlier polls through Real Clear Politics. Very, very well followed uh, research group. And, President Trump at this point, again, we're about 10 months out of the election, so a lot will change. Has a slight lead over President Biden. Maybe things will change. My guess is 6 months from now, when we're doing this, we're probably going to be talking about the same two people, and we'll see what happens. So that always has a little bit of a negative effect on markets, just because it tends to add to volatility. That's all I got. I'll leave it there.
I'm sure we'll have more opportunity to talk about it as the year goes on.
And I think as we get later in the year, potentially maybe we can get somebody from one of the research groups in Washington to come on and kind of give us their feedback. But I'm going to guess I'm right on that one. I think that's where we're going to end up. So this is a really busy chart, and I apologize, but this is something we talked about earlier. I said as we see the markets expand, and late last year, as you can see up here, it's a small print, but on the day after Christmas, December 26th, we got to a point where 90% of the market was above its 50-day moving average, which to me says you're expanding the breadth of the advance. It's not just the 6 or 7 or 10 names. It's a lot of names participating. It's impossible to get above your 50-day moving average without participating in the rally. And historically, when that happens, a year later, it's happened 20 times. As you go back to 1967, and out of those 20 times, 20 out of 20, the markets were up a year later, and they were up about just under 17%. So again, it's not so much the returns; it's just the fact that they tend to be positive. So you have a positive momentum and positive direction in the markets, and it's another data point we look at as we're trying to figure out where the markets are heading. I think it's had a great track record. I've been following it for 20 years, so we'll keep an eye on it as we go. But history would tell you, at the very least, it's a tailwind going forward. Again, Ned Davis puts out a chart that goes to the composites of the year, how the market tends to go on composite cycle. And this takes in consideration the presidential cycle, the 1-year cycle, the decennial cycle, which is every 10 years, kind of puts it together. It's not so much the return that it shows, it's more the direction and how the market tends to move. And again, going back to the slide with the presidential year, you tend to get some consolidation in the first half of the year, and you see better returns in the second half. These don't always follow in line, but it's maybe the best. If you're looking for some kind of guidelines, it's one of the better ways to look at it. Historically speaking, they've fallen closer than you think. I don't know if we'll see a big pullback in May like it shows here, but it's more that over a course of 6 months, the markets are fairly flat, and then you see most of the gains in the second half. I would not be surprised if that's how it works again in 24. And last slide or two. Again, I think this is one of the more hated bull markets, mainly because, as Emily mentioned earlier, the risk-free rate return you can get on a money market is fairly high, so there's not a lot of reasons to put money at risk. But there's about $6 trillion on the sidelines. This is from Apollo Group, and at some point there'll be what they call FOMO, or fear of missing out, if returns do stay positive. And I think the cash on the sidelines will start to return back to the markets, either in the form of buying bonds or even buying equities. But the longer term trend there, we got up during COVID up to about 4 trillion, and then we kind of stayed somewhere between 4 and 5 trillion, and then we got up to 6. I think we'll see some of that money come off the sidelines this year.
That seems to be like a historical high. I mean, I don't recall ever seeing it that level, but
yeah, it actually says record high right here.
Oh, yeah. There you go.
So it's a very high number. Could it go to 7 trillion? It could if rates stay high or there's a lot of fear in the markets. But eventually, people tend to go to cocktail parties and realize, hey, everybody else is making money in the market except me, and then they tend to get so just human nature. And then finally, we talk about this to clients all the time. I don't know how many times I've said this, but it's time in the market, not timing the market. And if you go back to 1950, there's a block here at the top. Returns for stocks have been about 11%, bonds about 5.5%, and then that 60-40 portfolio, which we talked about earlier, is just under 10%, 9.3. The longer you hold the strategy, or longer you stay invested, the more likely you have positive rolling periods. There's only, again, on a 10-year basis, the worst you would lose on an average annualized basis is 1%. The best is 19. On a 1-year average, so that fluctuates quite a bit. This 39, I think, is either 2007 or 2008, over the financial crisis. But again, the longer you're in the markets, the better. We're not market timers, as we've said many a times over the years. And I think from an allocation standpoint, it's always something you can have a discussion with your advisor. But I would stay invested in the markets. And overall, to your point, Emily, we're fairly positive on the markets. I realize that it's an election year. I realize there's a lot of geopolitical issues going on. I think the two drivers that we're watching outside of the fundamentals would be the direction of Fed and how fast they cut. And like I said, we do think they will cut rates this year. How fast and when is really up for debate. And then, will inflation continue to trend lower? And so far, most indications are that, it will. I don't know if we have to get down to that 2% target of the Federal Reserve to claim victory. I think if we get some consolidation down in the mid twos, and it looks like there's no threat of it reaccelerating, I think that'll be close enough. But again, we're keeping a close eye on that as well. So, as always, I want to, if anybody has any questions, feel free to throw them out there. I want to thank our marketing group and Annika for putting this together, and the investment team for helping me put all the slides and thoughts and themes together, because it's definitely a team effort. And I'll let Emily finish, but if anybody, we're always open for a Zoom call or whatever. Contact your advisor, and myself or one of the team members are happy to jump on a call.
Hey, John, I was just going to say, I think I've covered all the questions from the chat, but we just got one. When in the year will we see the first trillionaire?
Well, do they know?
Will it be me? That's what
I don't know who that person will be. If I had to pick a guess, I would probably say Elon Musk, although the price of Tesla stock's been going down. It's 90% of his, or probably 100% of his worth. So that's a good question. I mean, I don't know. I don't think we'll see one this year. I don't know. I thought the richest man in the world or person was somewhere around 200 million, right? So that's a pretty big jump. But I'm sure we'll see one in our lifetime. It could be one of the Saudi princes. They might be trillionaires already, and we just don't know it.
Yeah.
But
a very private individual, I'm sure.
Yeah, I'll put it this way: if we do see a trillionaire out there, it's probably because the markets went up and they own a large stock, Microsoft or Google or Tesla or whatever, which will probably be a good indication that most people that are invested in the equity market will probably have done well. That's probably a bigger thing.
All boats rise. All boats rise. Well,
Exactly.
I think we did cover any questions in the chat. Feel free to reach out to your advisor if you've got others. I just want to say it's our privilege to inspire you and your families. We can't thank you enough, and we thank you for joining us today, and hope to see you next quarter, if not before.
Bye. Thanks, Emily.
Thanks, John.